Hey, good evening, guys. Kind of Tortoise Capital with Phil and Griff, and we are in session number two of the book club for our first book, Foundational Trading. And here's our schedule. Last week we did the introduction of the authors, a review of the Cornell note-taking method, and we reviewed the table of contents and organization of the book. And then in the opening section, it was really a discussion of the background and principles and values of our community of practice and why a community of practice is similar to masterminds and accountability groups and learning organizations, and how we try to use the elements of all of those in our collaborative learning. So I didn't receive any questions from our first session, so it was either unusually clear or had chased everybody away. But if you're in the sound of my voice and you have any questions about any of that stuff, you can always send it to me. I would just ask you to put in the title of your email, just put book question and send that to longke@yahoo.com. And then I can make sure to get it into the discussion for the following week. This week, we're looking at sections 3 and 4 of the book. In future editions, we might even call those chapters. And we're looking at pages 53 through 93. And it's going to be a discussion of trading challenges, why it's so hard to make easy money in the markets. We're going to take a look at some really important and powerful books and thinkers that have influenced our trading methods, with a hat tip to those guys, both for reference and for inspiration. Next week, we'll be looking at sections 5, 6, 7, and 8, and we're going to be doing a deeper dive into conceptual models like system, self, and market, identifying areas where we have edges, important concepts and mindsets like plan, prepare, execute, assess, time, will, pattern, and money, zero state, process mapping, and things like that. So that's a preview of coming attractions. Again, it'll be always on Wednesday nights. We'll be recording all of these sessions and putting them into the course, which I have open here. So we talked also last week about how to use the Cornell note sheet for best advantage. And I want to give thanks to Griff for putting the notes together. When you are in the courses.owlgroup.us which is our site for hosting this course, if you go to all the live chat recordings, you'll get this, and you can see we've already got last week's posted, and then this week's, when it's done, will get posted here. And you can also download each one of those sessions from the download section if you want to store it locally and listen to it again. I should also say that in the audiobooks sound files section, these are all M4A audio files, and we're uploading these as we go. We're up to about, I finished uploading today up through, I think it was like page 165. So we're about, when I add Griff's in, we'll be about 2/3 of the way through the book. So you can already start downloading the book sections as we go. So before I get started into a review of the notes, I want to just go around the horn one time and ask if anybody has any questions before I just get into the note sheet. And if you do, we have a few enough people that you could come up on the on the net and just talk it, or you can type it as we go. Once I start, doing the lecture and whatnot, I'd ask you to um, type your questions into the chat box. Oh, I had the chat. I had the window minimized, so I guess we got more people than I thought. Sure. Yeah, if you wouldn't mind typing your questions then into the chat box, then that would be a way we can get through this in the allocated 1 hour. So here we are. We are in reviewing the book Foundational Trading. This is our book club meetup. This is session number 2, January 17th, 2024. We're taking a look at pages 53 through 93, which constitutes sections 3 and 4. And we're going to look at trading challenges, powerful books for reference, and inspiration. I like to start with the keywords section in the Cornell note sheets. I just feel like I like to know what the power words are that we're going to keep coming back to. These all happen to be mental models or habits of mind that are instrumental in the way we think about trading. What's interesting is that none of these, with the exception of black swans, has any direct connection to the world of trading per se, but they are all connected to foundational concepts in thinking and in organizational decision making. For instance, the theory of constraints, also known as talk, comes from Dr. Elihu Goldratt, who was really instrumental in the world of statistical process control and industrial engineering. And what he showed was how you could take a factory that was making multiple products like A, B, and C, and you might have machines in your factory and with a pile of raw materials, and you might have a manufacturing process using all of those machines that could make A or B or C. And then depending on which one that you needed to produce, you might have to stop production for a while and retool or reset up one of those machines. And what he showed people how to do was to organize for maximum efficiency, essentially by finding the critical path through the manufacturing network and finding the machine that was limiting overall performance. Where was the choke point? So if it turned out to be machine number 3, the important thing was to make sure that machine number 3 was always at work and that you were optimizing the operation of machine number 3. And then you would only produce enough at machines 1 and 2, and then 4 and 5, based off of the pace at which machine number 3 could operate. And then that was going to govern your overall production. Because if you overproduced at some of these other stations, then you had the problem of excess inventory. You had a problem that if you were going to change the setup or change the standard, then all the things that you had just built had to be reworked, and that was costly. And so if you were trying to maximize performance in these other areas that were not the constraint, then you might not put all your attention on the crucial element of your process that was governing your overall performance. So what Goldratt teaches us is to design your process map for input, process, and output, and really understand the way you go from left to right, how you take the raw materials, what you do to add value, what your measured output is, and what the required standards of quality are, so that you can organize your workflow in a way that maximizes your production in the lowest cost way. Well, that has very good applicability to what it is that we do, because as you start using the THARP model of 10 elements of a trading system, you need to view that as a process, a manufacturing process that's organized in a certain way. And if you bring the principles of the theory of constraints, then you organize that workflow in a sensible way. You find which is the most crucial element, the one that's governing your maximum performance, and then you optimize for that. So if you are a discretionary trader and your system is relying on good judgment, then you need to be relaxed and healthy and happy and in a zero state. And that's more important than having an overabundance of trading targets. Like if you only have a span of control of trading three open positions at one time, then it doesn't make sense to generate a lot of extra possible entries that you have to process if your limiting factor is three open positions at once. You got to find ways to increase that or to make sure that the three positions you have are the best possible payoffs given all of the other opportunities. So theory of constraints then is a way to take a look at our trading process simply as a manufacturing process that we can apply statistics and process mapping and value add to it. And you see that reflected in the way that we organize our planning and preparation, how we organize for execution, how we systematically approach assessing, um, how we find ways to reduce inefficiency, how we try to find the most important elements and do those well. So that turns out to be a really powerful set of ideas that I believe give us a long-term benefit. The second one is coming to us from the world of systems thinking. This is the soft systems methodology that is driven by let's see, I'm looking for Peter Checkland, tackling complex and ill-structured problems. What what Checkland teaches us is that in the world of systems thinking, you got to recognize that there's these little bodies of knowledge, each one of which represents a different style or an approach to systems thinking. There's some that use a biological model, like plants and agriculture, biology. There's some that come from the world of manufacturing and robotics. There's information theory. And then there's the soft systems methodology of Checkland is really geared towards understanding human-centric systems, which he calls soft systems, that people are softer than robots, that we deal with nuance and language and interpretation and emotions and psychology. And so when you are working with any system that features human intervention or human participation as one of the primary things, then soft systems methodology gives you a way to appreciate what it is that psychology and sociology and human factors do in the performance of that system through all kinds of weather. And so that model helps us as traders, particularly if we are discretionary traders or systematic traders with discretionary tendencies. To the extent, if you said, look, I got to draw a line and say, how much of my systems are based on rules and how much is based on interpretation, the more that you do that requires discretion and judgment and interpretation, the more human factors can be found in that system, and therefore understanding the principles that come out of soft systems methodology is really useful. And so we found that to be a very practical way to develop robust systems for humans to operate that takes into account what we know about human psychology and organizations. Sometimes my experience has been that trading psychology can become a little bit too much about trading and not enough about psychology. And one of the benefits that we get by taking a look at Chucklin's work is by examining what we know about humans and systems in a lot of different settings. So I think it prepares us for a lot more of the psychological stresses and realities of trading uh, than than just a pure focus on trading psychology. The other thing that it helps us do is understand the world of business and finance, because that has been used quite a lot in the financial services industries and with the business cycle itself. So, if you are trading your beliefs about the market, or you are trading what you believe to be the psychology of the masses, then having a grounding in something like soft systems methodology always keeps you mindful of the impact of humans and their psychology and herd behavior into the movement of price. So that's been an important model for us. This one, appreciative sharing of knowledge, comes from my doctoral mentor, Dr. Tojo Thatchenkari. He was on my dissertation committee, and we still work together um, in helping to build the MBA programs in India. He's paying back some of his grounding and to his Indian roots, and so I've been helping him in that area. His work on appreciative sharing of knowledge uh, has the following value for us: that if you were to organize an accountability circle, that you could trust, and you had evidence that everybody in that circle was doing their best to tell the truth about what they saw so that all of us could benefit, then you could put issues or systems in the center. And then as people commented on it, you could you could build a collaborative learning environment that would be much more powerful than the sum of six different insights. You get a synergy where the whole is greater than the sum of the parts. Well, what Tojo gives us an appreciative sharing of knowledge is that he's developed a model and a process that allows us to systematically maximize the performance of groups by having people come together and simply tell each other stories about what you find most beneficial from the work of other people. So if I'm this little guy over here in the red and it's my turn to talk, I might say, hey, what this guy in the yellow, the thing that you do that really benefits me the most is such and such. And you end up and then the person in green talks about the person in yellow and says, here's what you do that really adds value to me. And what happens is that the things that you do routinely, you just kind of take for granted. You say, well, there's nothing special about what I do. But when you hear everybody else in that circle giving you credit and praise for the things that you do that benefits them, what it does is uncover where the real hidden value is hiding in plain sight about what really adds quality. I my own example of that is I think most of the things that I do are just pretty straightforward and nothing mysterious, but I get a lot of praise occasionally for some good ideas, and I know what it takes to do that, so it doesn't seem special to me, but maybe it's just the way I package it or whatever. But when you start adopting the principles of appreciative sharing of knowledge, you develop an approach which is really looking for the most powerful advantage and quality that's coming out of everybody in your circle. And when everybody is kind of committed to that mindset, you end up getting a very mutually supportive and trusting environment in your accountability group that really makes it a powerful force for learning, because you learn to trust, you learn not to worry about offering things that seem simple to you. You're just trying to offer your best work, and you let other people worry about coming up with the value judgment. And what it does is it accelerates the learning that is possible from a small group. So this has turned out to be one of the really powerful tools that we use in developing our groups. High reliability organizations comes from the world of Carl Weick and Kathleen Sutcliffe. And what they do is they took a look at thousands of businesses and they said, 90% of new businesses fail in the first 5 years. And then in the next 5 years, another 90% fails. So if you can get past 10 years, then you have a fighting chance of surviving. Well, the people that start businesses um, are operating from a world of passion and belief and total commitment. So wanting things to be true and wanting them to succeed turns out to be insufficient. It's probably necessary, but not sufficient. So failure in business and failure in large organizations is to be expected. But then you take a look at some organizations that live in the world of maximum complexity and fail catastrophically if they're not successful. And two that come to mind that they write about are like nuclear power plants and aircraft carriers. Both of those are incredibly complex, and the margin for error at every step of the way is minuscule, and yet they work. How can that be? And that was the question that Sutcliffe and Weick studied. They said, what are the characteristics of high reliability organizations that allows them to survive in a world where failure is normal? And what they found was that there was 5 principles, 5 categories of behaviors and culture that made high reliability organizations different substantially from just normal businesses. Like the first thing that they thought was important was they expect failure. And so they're not surprised when they see it. So they expect plans to fail. And so what that means is that they build in redundancy to their safety systems and they invest a lot of time and effort and sensors into discovering where the plan is starting to fail. So they're not surprised when things fail. They actually look for it. In fact, if things aren't failing, they get a little worried because they wonder why it's so different. And then they don't assign blame to people when something in their area starts to fail because they know how easy it is for things to fail. So they don't punish people for failure. What they do is they reinforce the safety mechanisms, they give them the support they need, and then they reward them for telling the truth about performance that's not perfect. And that allows them to more quickly discover where things are going wrong so that they can get the resources there to fix them. So the other 3 factors that they have are associated with that kind of thinking. So when you put all of those things together, principles 1 through 5 of high reliability organizations, then you can actually incorporate that into the way you structure your trading business and the way you look at your trading plan and the way you perform in any given trade. And I have found that to be extremely helpful when it comes to managing a trade. Like I think principle number 3 is attention to deviation early. So what we look for is on a standard trade, we might think that thing has reversed and starts to move up. So we buy an entry here and we have a little risk box there. And we expect that to come up to our price target if all things go according to normality. So we think it's supposed to do that. So what we're looking for are places where failure starts to happen before it gets to the routine target. And then we manage that very carefully to decide how much error is enough to tell us that the probability of failure is going up and that it's not a trade that goes up to here. It's going to be more like a trade that fails from there. So, this attention to detail and looking for evidence of failure where failure can be found avoids the problem of cherry picking data to confirm your bias of success. It inoculates you against a belief that your system is perfect or that you're right. It really is a way to expect failure and then look for it and then manage to it. So the principles of high reliability organizations turns out to be a robust way to turn our trading systems and businesses into an organization that's like a nuclear reactor or an aircraft carrier becomes a powerful way to deal with a world that is filled with what is called VUCA, volatility, uncertainty, complexity, and ambiguity. Each one of these things introduces errors and problems into routine systems. Each one of them is a slightly different kind of a challenge. And when you get the combination of those, the that gives you many opportunities to have your best laid plans to fail. So HRO, high reliability organizations, helps us thrive in a world that is characterized by VUCA. And I think that's one of the reasons that our best results come from periods of maximum volatility in the marketplace in any time frame. That's when we do our best. And I think it's because we're actually prepared and looking forward to the occurrence of volatility in VUCA. The next one is Nicholas Taleb's Black Swans. And what that one helps us understand is the limits of normality as expressed through stats. One of the things that statistics relies on is the characteristics of the data set that you're working with and the processes that are at work in the world to generate that data. And what you want for statistics to work are things that are normally distributed and independent operations. Well, it turns out that financial markets do not pass that test. Financial markets are not normal. And there is asymmetric information about the market available to participants. So it's the asymmetry of information means that some people know more things than other people. And then you get a series of events that trigger other events that triggers momentum. And pretty soon you get asymptotic parabolic moves that distort or do not comply with the laws of normal probability. So Caleb's work in the Black Swan is a really important way to understand under what conditions you can use statistics and where the use of statistics can actually harm you. So Taleb is a really important thinker in that regard. And finally, the last one I want to highlight under the keywords is the principles of Stoic philosophy and as best expressed in my view by the Roman Emperor Marcus Aurelius. And oh, yes. So a Stoic philosophy ends up being a very practical way to understand a world that is indifferent to your feelings, that it's going to behave the way it behaves, regardless of how you feel about it. It doesn't worry about your dreams and hopes. Um, Stoic philosophy helps us understand the difference between want and need. It helps us deal with a world in which there is inequality and things aren't always fair. and perfect. So a Stoic philosophy ends up giving you the uh, helps you build resilience and mental toughness and independence of mind and habit, and it turns out to be like in sickness and in health, good times and bad times. Stoic philosophy, like a good spouse, is always there, and especially there when you need it. So, those are important top level concepts and ideas that are foundational to the way we developed our trading systems. I want to jump over here to systems, self, and markets and talk about where the information came from that is found in pages 53 and 93. And the first one had to deal with the psychological challenges of trading. So, what I did was review the work of about 200 trading authors, and that included traders, um, analysts, psychologists, that's all of whom specialized in trading. And what I did was I took the top 10 ideas of each one of those 200 folks in the area of challenges. And and I found what were, so maybe the first guy had 10 ideas. And then the next guy he shared some, and then he offered 11 and 12 and so on. And then we just ranked them by frequency and importance. And we took the top 10 ideas that had the most votes from a couple hundred authors, from their lives, from their practice, from their studies. And these are the top 10 psychological challenges, which turn out to be the most difficult parts of any trading system. So the work that I did that was, I think, most helpful to Van was the idea of systems, self, and markets, that each one of those represents a body of knowledge. And that when you put those together, the integration of them in this centerpiece is the sweet spot where your skills and capabilities of self and understanding good systems and understanding what the market will give you, that creates a sweet spot in the middle in which you have maximum alignment. That's the sweet spot. And one of the things that we do when we're assessing our performance is we're checking on alignment. And what you have to have is all three of these. So if I do a very good job of understanding myself and I've chosen systems that are strongly aligned with me, that's good as far as that goes. But if I tried trading those in markets that don't align with my psychology and with my systems, then I'm going to underperform. So because I am not trading markets that are appropriate for my strengths and my systems, I'm out of the sweet spot. What I have to be able to do is understand myself enough that I can design systems that I believe in and that I can operate and trade those in markets that are appropriate for that combination of systems and self. And then I could say I am within that sweet spot. And now I have a chance to get the maximum performance of the intersection of those three elements. So it's possible for us to separate this out and to do some psychological work, and then to set that aside and then just go work on developing a trading system for a while, and then to do some work on market classification. But I actually have to do the extra work to synergize those, to bring them together in order to uh, have my maximum performance. Well, if you take a look at all three of those elements, the one that changes the most or that is most vulnerable to error turns out to be our psychology, because it's such an important part of our total understanding and our behavior. So that's why understanding the top 10 psychological challenges of trading is so crucial. And pages 57 through 59 give a brief overview of what those are. And then, if we want to do the same thing about the systems element, these turn out to be leading thinkers and books that you can consult, that if you need to do some work in those areas, the places that we go to get the best bang for the buck, the best use of our time, have been through this set of books, like The Trading Strategies, Technical Analysis, and Psychology of Dr. Elder. Now, that's a great book because in addition to talking about systems, he also does spend time on psychology and then on market strategies. So that turns out to be a powerful integrated book. But if you're looking for systems, you can also look at the work of Wells Wilder, Larry Connors, Larry Williams, Ed Seykota, Marty Schwartz. A guy I particularly like is Perry Kaufman. He has, in addition to this one, Algorithmic Trading and Trading Systems, he's got his Encyclopedia of Trading Systems is literally a book that documents hundreds of different systems that people through the decades have tried to use when it comes to the intersection of systems and markets. So Perry Kaufman is a real giant in that field. Quantitative trading as a specialty, I broke this one out separately because the work of Dr. Howard Bandy, for me, is at the very highest point, the pinnacle of professionalism when it comes to understanding systematic trading with rules and computers and modeling and formulas and statistics and math. Quantitative Trading Systems Analysis by Dr. Howard Bandy is the epitome of excellence in that area. But all of these guys made significant contributions to understanding the systems element of self systems and market. I don't have to spend a lot of time with you saying, hey, why would lack of discipline be especially problematic to a trader? And you can see also that the more frequent that you trade, like if you're a day trader or a swing trader or a position or core trader where you're trading, once a month, the more times that you're trading, the more opportunities that you have for self-doubt, lack of discipline, psychological errors and stress. The more that you're trading and the more that your judgment is a part of your system, the greater the impact of self and psychology. And because most traders, in my view, tend to be more frequent traders than investors in general, psychology is an extremely more powerful element of their performance than just say passive index investors. And that's why Van used to say 90% of all your results are directly coming from psychology. And later he would say he wasn't sure if that number was high enough. So emotions can override your decision making or distort it. Cognitive biases could be associated with how you actually designed the system. Like you might have been designing a system based on some assumptions and mind uh, maps, mental models. But if those things were infected by cognitive biases, it turns out that the errors that you're making in psychology and analysis bleed over into designing systems incorrectly or incorrectly understanding how those systems are going to perform in certain kinds of markets or what the psychological pressures might be. So it turns out that the root of all evil, but also the root of most of your success, is going to come from the area of psychology. So, in our view, these 10 psychological challenges are absolutely essential. That if you read all of the 200 traders, it turns out that the guys that are really good traders, there's probably one or two things that they do that were particularly useful and unique to them, but they probably had eight or nine things that were held in common that all traders should do. And so what we're trying to do is in our foundations course, for example, is make sure that we take care of all of the things that represent the greatest challenges to the most number of traders all the time. What we're going to do is build out a separate course that takes each one of these as its own weekly lesson and learn how to dive deeply into it based on the insights from those many hundreds of authors. Because what we also did was come up with their best ideas on how to optimize or to improve or overcome each of those challenges. So what we are going to do in that course is basically take the take the challenge and then come up with the best collection of integrated strategies as recommended by leading authors, but also as reflected in our trading practice. So you'll get the best benefit of uh, our research, but also our activity. And you get the experimental and practical insights as well. And you'll see that already baked into the cake in the courses that we already have that are that show ways in which we can overcome those challenges. What I think is essential here is this quote that Griff pulled out. That is, the most persistent edge you can have is to adopt a professional attitude and a professional stance in everything that you do. Like what you're trying to do as a professional is not necessarily beat other professionals. What you're trying to do is beat amateurs and hobbyists. And simpletons, because a lot of guys that have professional credentials are not really skilled craftsmen. That if you take a look at the hierarchy of skills, and you have like novices and journeymen and craftsmen and masters and then artists, most folks that are managing money in the world take a couple dozen hours of courses and then they are really just passive index traders. And what they're really doing is they are providing the professional discipline to actually execute long-term buy and hold with annual rebalancing. That's a really good strategy compared to what hobbyists and amateurs are doing. It turns out to be a reasonable target for a professional trader to try to defeat that kind of a strategy. But most of the folks that aren't using money managers are coming from the world of hobbyists and amateurs who are driven by exactly all of these psychological challenges, which is why the herd routinely, predictably, almost mathematically have to underperform long-term buy and hold. And the fact that active managers rarely beat the S&P 500 for more than a couple years tells you that that most active managers are either simpletons or they're operating with constraints according to the rules of their investment fund that create limitations and constraints on their performance that we as independent traders don't have. So as professionals, if we can adopt a professional attitude with respect to systems, self, and markets, and be disciplined about it and collaborative about it, then it becomes much easier to defeat the work of amateurs, hobbyists, and limited professionals. And so the most important mindset in being a professional then is to be a serious person, respect the game and the opponent, and lay the groundwork for developing and sustaining the professional approach. That's why book number one for us spends time on these kinds of long-term persistent edges that come from the world of organizational theory and practice, not just we happened to find some lucky solution that worked for a couple of weeks and wrote a book about it. No, we're talking about the results of hundreds of thousands of man hours of research, study, and application, finding out what works in the world. And this mindset that we talk about in the book there is central to the idea of professionalism. So, why is it so hard to make easy money in the markets? Uh, there are three lenses, three kinds of challenges, or three categories of challenges, and they actually relate to system, self, and market. That there are challenges that just come from any kind of publicly traded market anyway. The elements of VUCA that I talked about before: volatility, uncertainty, complexity, and ambiguity. Um, all markets have those qualities. And there's a set of about 10 challenges that we itemize in that section that you should appreciate why it's so darn hard just because you're in a market with competition. And then there are challenges that are directly connected to mastering the technical skill sets of trading systematically. So if you take a look at the simplest classification of traders as systems versus discretion, most people really are discretionary traders, and very few are genuinely rules based systematic traders. And even the guys that are really systematic, a lot of times you'll see that they have their system is like me, I would say, is about 80% rules based and about 20% judgment based. So even if you're on this side of the aisle, there's still elements of discretion in there. But if you're not good with math and you're not disciplined and you don't know how to do Lean Six Sigma and standardize your work and be disciplined in the execution and learn how to set up your systems so that it becomes harder to not follow the system than to follow the system. Well, if you're not already that kind of a person, you're a discretionary person, that's where the psychological challenge is magnified. But even if you come over onto this side and go systematically, there's a whole new set of challenges that come from the world of mastering technical indicators and coding and robotics and systems thinking that allow you to go wrong in ways that a discretionary trader doesn't go wrong. It's a new set of errors waiting to be made. It's a new set of skills that have to be mastered. So not only do you have to overcome discretion, but you also have to learn to be systematic in a professional way. So those are some of those challenges. And then finally, the challenges of mastering our own psychology, which is really learning how to address and overcome each of those 10 different challenges. So understanding the world of system, self, and market and the intersection of those can give you an appreciation for why we take an engineering approach to the world. Any one of those three domains is hard enough to master by themselves, but when you add in the multiplication of the complexity of three different bodies of knowledge and try to create a fourth body of knowledge where they overlap, you end up learning that there's not just science, And there's not just art, there's also the world of craft, learning practical ways on how to do science and practical ways to how to do art, and then practical ways to find the good balance point between art and science. You have to learn all three of those areas in order to blend and get the best of system, self, and markets. You know, if we take a look at, we jump down to the bottom of our note sheet here and take a look at Griff's synthesis. You know, he said, notice how many influences there are under the topic of decision making, which is really influenced by all of these frames of reference, all of these challenges for system, self, and market. And that's not even coming into the technical elements of how to set up a process to make good decisions and set up a system of learning so that you can continually get better on all future decisions. So it's not enough just to do your best to make this decision today. You also have to study that so that you can be better at making decisions tomorrow based on what you learned from today's assessment. So that leads us into some of the more specific books and thinkers, practitioners who influenced our work. And this section of the book from 61 to 81 takes us into 5 different domains of technical competence for trading decisions, like principles of trading psychology. I just don't think you can do better than Dr. Tharp. And then as a practical trader, Mark Douglas, Trading in the Zone. Holy mackerel. And then a really great psychologist and a great trader himself, Dr. Brett Steenbarger. He had many advanced qualities too, but I find the balance and the trade-offs between those two guys to be really helpful. And then for me, I take my trading execution, I take the psychology that comes from the martial artists Miyamoto Musashi and Yagyu Munamori, Japan's two greatest swordsmen of all time, and the relentless approach to mastery of self that they represent. So that to me, trading is like the psychology of war, of combat, of competition. And that's not the only model that can work. It's just the one that resonates the most for me because of my personal psychology and my experience of 45 years working in defense of the nation in the Army. I cannot escape that frame of reference. And so I dive into it full bore, and the thoughts and psychology of Miyamoto Musashi and Munamori are central to how I interpret the trading psychology work of Tharp, Douglas, and Steenbarger. I've also made a deliberate research practice of decision making and continuous improvement, not just in the world of trading, but in the world of manufacturing, logistics, strategy and tactics, military decision making, organizational theory. And these are, in my view, the top 10 authors whose work most influenced me and who I continue to read as a way to understand my own trading and that of the people that I coach. In terms of data-driven decision making, applied statistics, continuous improvement, and quality control, the godfather, Dr. Deming. And then Goldratt, I talked about in terms of improving processes. Donald Wheeler is a giant in the world of statistical process control and understanding where variation comes from. Like, what are the things that can vary in our trading ecosystem that can cause us to get different batches of results. How do we detect those? How do we detect which ones are normal and which ones are out of tolerance to tell us something is breaking? Donald Wheeler is central to the world of statistical process control. Gary Klein is a psychologist who takes a look at how experts make decisions in the real world. So, naturalistic decision making is really an important contribution he makes, particularly to artistic decision makers, intuitive decision makers, discretionary traders. Donald Schoen spent a career of understanding where mastery comes from. How do you go from novice to master in a discipline that requires not just science, not just art, but also craft? Schoen is instrumental in understanding the relationship between teachers and students and how the teacher teaches the students and how understanding the student and studying their results helps teach the teacher about the discipline and the world around him. So you actually need both members to have experiential learning at the top level. You see that in every discipline and in every profession that has a performative nature to it. Henry Mintzberg is, in my view, the leading scholar of integrated management theory in the world. He understands that leaders and managers are heads and tails of the same coin. And so he understands how to translate strategy into behavior and tactics better than anybody. And he's very strong in the world of developing craft knowledge and rules of thumb to manage complex systems. And that is central to the way that we look at improving our performance in as a trading business. Um, Anders Ericsson is a genius at understanding how to connect the best kind of deliberate practice to develop expertise the fastest. Sam Stabbage is an applied statistician who teaches us how easy it is to make errors with math and statistics in his book, The Flaw of Averages, and how to correctly apply statistics into decision making. Dan Ariely looks at the irrationality of human decision making and helps us understand why the herd persists in irrational behavior and how you have to understand that as a central component of market behavior. Um, James Clear helps us develop bulletproof systems and atomic habits. That's how you improve your performance through checklists and changing your routine behaviors. And Julia Galef has done a really nice job in the scout mindset of showing us what it takes to have an inquisitive mind, a curious mind when we're being a scout in the world, and how to bring that back to the tribe and turn that into effective systems. Because we got to have good systems and culture for the tribe to succeed with routine behaviors. But before they become routine behaviors, we had to send out a scout to investigate the world in a low risk way. It was high risk to the scout, but low risk to the tribe. That's where your entrepreneurial curiosity is developed. She's done a nice job of helping us understand what it takes to have the scout mindset when you're taking on inquiry and learning and curiosity. Problem solving and planning teaches us how to turn data into reliable, robust, reinforced organizational decision making, how to design your dashboards. So Kenichi Omai, who helped develop the Toyota production system, Peter Checkland in soft systems, Edgar Schein understanding how people integrate systems in a human way, and then Thatch and Carey's work on uh, appreciative inquiry and sharing of knowledge helps us build powerful collaborative accountability groups. Uh, Complexity and uncertainty is a direct connection to the world of markets and to systems. That the world is not only stranger than we know, it's stranger than we can know. And so you have to learn how that your simple rules that are black and white don't survive contact in a world that is dominated by VUCA. And so understanding the work of Herb Simon and James March with bounded rationality and understanding when is good enough, it helps you avoid the perfectionist bias. And then the HRO work of Wyke and Sutcliffe tell us how to build that into reliable systems. And then Kahneman and Tversky won the Nobel Prize for understanding behavioral psychology, behavioral finance, and how our cognitive biases can affect decision making, and therefore what we need to do to protect ourselves against our internally generated errors. And then Taleb helps us with the outside world, understanding the limits, probability, and statistics. And Marcus Aurelius teaches us how to live in a world that is dominated by fuzziness. The last section on storytelling and creativity, to kind of bring us back to home base, is that the way that we make meaning out of our experiences is generally through the world of storytelling. It's how we see the world, it's how we communicate about the world, it's how we remember the lessons of the world, and how we do rapid testing and thinking for possible strategies through the use of story thinking. And the two giants in that field are both research partners of mine, Dr. David Boji, who was one of my doctoral mentors, along with Tojo Thatch and Carey, and then Angus Fletcher with the Creativity Project at Ohio State. Both of their work features prominently in our creativity work and in the way that we perform our weekly check-ins for um, the foundations course and the small group coaching. So to reinforce Griff's points, just notice how many things can influence decision making and why we need such a wide variety of tools in our kit bag in order to deal with a world that is organized and dominated by VUCA, volatility, uncertainty, complexity, and ambiguity. Um, and then when we start thinking about being of service to others, you can say, what am I not seeing about my own decision making? That's like asking, how can I learn to see my own blind spots? You're going to keep chasing your tail, or can I put myself in the middle of the circle when it's my turn and reveal to all my trusted partners, here's how I'm trading and here's what I'm seeing. What do you guys see with what's going on with me? And now I can incorporate many different points of view, each one of which is coming from its own unique set of experiences and training and beliefs. So now I'm getting the blended input from a tribe of trusted others. And now my opportunity to learn is many times greater than if I just tried to do it all myself. Like I don't have the time to go become an expert in each one of their systems. Better for me to just find a trusted expert in their point of view and listen to what they say and respect the gift that they've given me of their time and their insights. And then when it's their turn to come into the circle and my turn to be the observer and reporter, I'm going to repay that gift by doing my best work at telling them with honesty and integrity everything that I'm seeing. I'm not trying to protect their feelings. I'm trying to protect them from getting destroyed in the markets. So my obligation is to respect them by giving them the best truth that I can. If I see something, I got to say something from my point of view, and I got to treat them with gentle respect, but I also have to give them the benefit of my truthful beliefs and observations and do that in a way that reinforces our relationship. So that's what we mean by last week's discussion of the community of practice. And so if we have different groups of people that have various degrees of skill in all of these areas and all these backgrounds, pretty soon the synergy of those, the integration of all those different points of view and trading experiences gives us a really powerful learning ecosystem in which to learn. So that's what I wanted to say about sections 3 and 4 and pages 53 through 93. It's a really brief summary of tens of thousands of pages of world-class research, thinking, reflection, and application of big thinkers in many different disciplines, all of whom are offering things of importance to our trading practice. Not just traders, but people who are engaged in the kinds of decisions that traders have to make. So I believe that gives us a long-term edge in the market. You'll see a lot of these top-level ideas expressed in later sections in the book where we talk about what to do specifically about time constraints and psychological factors. And how can we learn to overcome our lack of knowledge? What can we do to improve our habits, to overcome a lack of discipline? And those are never binary. I have no discipline or I have all the discipline. No, it's a continuum. If I'm here on discipline, how do I keep moving to the right? At what cost in terms of time and money and effort? And what is the next best thing to work on? That's where we need to get into things like time management, self-development, and maximum rate of learning. That's why we spend time on learning theory as well as how to trade, how to enter a position. Should we use Williams percent R or stochastics or something like that? These other larger human-based factors are really important. And that's what we try to lay the groundwork with in sections 3 and 4. All right, that's everything that I wanted to cover tonight. I have about 5 minutes or so before we have to sign off to get ready for the next meeting. But if you have any burning questions, I'd be happy to do my best with them briefly here. You can jump in on the microphone or pump things into the chat box if you have any questions about tonight's work.
Hey, Ken.
Yeah.
I had a question, if I may. I was just curious what your opinion is about the like for decision making, the rate of decision making and your experience with, because I believe you were, longer term first and going from differences of swing trading, or maybe you have to get in the zero state for 5 minutes a day compared to intraday and kind of what that.
Yeah, there's I would like you to think about the challenge that athletes have. There are some folks that are running marathons that always have to be thinking about the long term. And so they're trying to be very efficient in the way they approach their decision making. So they want to make relatively few decisions during execution, and they're just trying to be very economic in what they do. Then there's other guys that are trying to play a team-based game on a field with the ball and a lot of variables like soccer, where I have to make a lot of decisions. I still have to have fitness, but now the amount, the number and the type and the complexity of decisions I have to make are different. And the nature of the decision that you have to make is an important part of the theory of decision making as well, such as what's the payoff for the decision? What are the consequences for me if I get it wrong? Like uh if I'm in charge of a portion of a hedge fund that only has to go find the 1 in a million company that's going to hit a home run and become the next Google or Microsoft, and the consequences of failure are not large because I'm only going to put $1,000 into each of these companies. Like they're going to give me $1 million, so I got $1,000 bets, and my job is to find the widest range, the most diverse set of companies that I can early enough in their phase. And there's no expectation that I can do anything that predicts why this company is going to be better than the other one. So the kinds of decisions I have to make there are different than if I have a bag of $1 million that represents the entire life savings of everybody in my village. And I have to go play a game in Las Vegas that is going to, if we win, is going to set up our village for success. But if we lose, then we're all back to zero and maybe the village disappears. So the consequences of decisions and is shapes how I would answer your question about decision making. Like, how many decisions do I have to make? What's the time interval? Are the decisions connected that build on each other so that I can be tentative and broad first and then learn forward on the basis of what I learned from the previous decisions? Or is it like the roll of the dice in which each and every time it's an independent exercise, and the way I make a decision on how much to bet is much different than uh, a situation in which I can learn from my decision making. When I think about all of that, I recognize that when I'm putting together a business plan as a trader, some of those decisions are long term and consequential. Some of them are short term and tactical, and I can revisit them a lot. Like, how much storage space do I need to have on the hard drive? Well, I can always buy more if it's not enough, or I can sell off some if it's later. But then there's some that have, there's no going back. If I take this direction, I can't take the other direction. So one of the central elements of decision theory is understanding what kinds of decisions you have to make, how long they have to be good for, how good they have to be, what the consequences of failure are, and then what the cost of additional information is. If I'm operating in a world where I have limited information, but for a price and for a certain amount of time, I could get better information. Now I have to make a decision on, should I defer this decision until I get more information? Well, how much other information is out there? Why do I think there's more information? And why do I think that information is going to help me make a better decision? How much do I lose by deferring my decision until later when it turns out that the advantage that I got was not worth it? Like, get there first with the most. A stitch in time saves nine. So that's why Mintzberg talks about decision making for leaders and managers as a combination of art and science and craft, that there's really some kind of integration between all of those, that the best decision makers are ones who have the skill on a case by case basis of detecting for an unknown problem set, how much art, science, and craft should I apply to this thing that I have limited information about? And I have to make quick decisions because I got 20 different decisions all coming at me. And if I spend all my time on the first one, I run out of time to address these other ones. And I don't know which one of them is the most important decision because I don't know the sequence and the timing and the importance ahead of time. Well, there's some certain things that I can do with the way I limit my behaviors. I might pick just some markets versus other markets and try to simplify my life. Um, like I could trade Forex so that I have 23 and a half hours a day to get the move. Whereas if I'm in equities, I only get 6.5 hours where the market is open. And then I have 17 and a half hours where I can't change my position, but I'm subject to a lot of news. There's a lot more deferred, delayed VUCA and risk in equities compared to Forex for that reason. So even though I'm using a trading mentality and a trading system for Forex and equities, there are important differences in the decisions that are being made in each of those areas. What I would say is that you should think of decision making as a skill, as a craft, that you can get better at it through nutrition and rest, and you can incorporate some cyber thinking. So if I can do some decision support, and that's where you get into decision science like ORSAs and spreadsheets and models. If I do something like the auto framer, that is a simplification of a complex world into a single ratio that allows me to compare choices rapidly so I can quickly get onto things that have the best potential reward for a given amount of risk. That's a simplification. That's a good decision to use the auto framer. Instead of trying to be perfect on every possible system, I can just restrict myself to the ones that statistically have the greatest potential payoff most of the time. That's going to automatically improve my return if I can trade it without error or reduced error. So the question you asked about, what's up with decisions, that's why it takes more than a 3-minute answer if you are a serious person when it comes to decision making. Um,
Yeah, so I
so
realized
that's
right
my,
after I asked that it probably wasn't the best thing to
yeah.
do with 3 minutes left.
No, I mean, it's a go. I mean, it kind of threw me a softball, lets me rant a little bit about decision theory. But in general, what I would say is my general approach of being I consider myself to be a rules-based trader, about 80% of what I do, and about 20% to be discretionary, where my trader quality number, which is a thing that we'll see in the near future, and the system quality number are concepts that we'll see in the near future. So a rules-based system is something that is a system that can be traded by a robot with perfect error-free execution, if I've written the code right? And for a given stream of price inputs, if I have the robot trade that, his performance is going to come out in a histogram, and then that's going to be analyzed into a system quality number. As soon as I start adding human discretion in there to say, well, sometimes I enter and sometimes I don't, and sometimes I get out here, and other times I add a position. And if I have intuition or contextual judgment, I've introduced some variation in how I apply my own discretionary rules, which now means that if I am combining those two, I actually have to trade my system purely as a robot and then trade my system the way I trade it with my judgment. And then I have to compare the different performances. And if the system quality number of the robot generates this much gain, but my trader discretion gives me this extra boost, then I can say that I have a positive trader quality number, that my judgment and discretion is adding that much value. But if it turns out that my judgment is causing me to lose that much money, so I'm only gaining this much, then my trader quality number has a negative impact on the system, which is a pure expression of mathematical rules. So what I try to do is really generate good code that error-free expresses the rules that I want. So I got to come up with a good rule and then code to execute it, and then understand what the robot will do when he trades it mathematically correct. And then, because of experience I have as a trader, and I know where my strong areas are, there are times when my judgment I think is appropriate. So I will find ways to use my judgment and intuition and rules of thumb to explore different ways to add discretion. Now, if it turns out that I find a couple things that work, as soon as I can repeat my intuition multiple times, I start trying to turn that intuition into new rules, like the WMB3 turns out to be a rules-based system that incorporates the intuition of the morning hook. So there was a pattern that I developed called the morning hook, where it closed here and then it opened up with a big hook, big gap down, and then it sold off sharply and then would make a big upward move. Well, I called that the morning hook, and the vision of that pattern had a certain feel to it. I could recognize it when I saw it, and I could look at 10 charts and see which one of those 10 looks most like this template for a morning hook. And then I could trade that. Well, what I wanted to be able to do was to take my artist's eye, my glance, and say, how could I turn that into a set of rules? So we developed the WMB3 rule set, which said rule one, it had to be oversold on Williams percent R. Then it had to have a MACD histogram uptick. Then it had to be a candle breakout compared to the previous bar, and do that on 3-minute charts. Well, we can turn that into a rule, and we can turn that rule into code. And if I like that, I can actually take that and eliminate my discretion and add that to the rules-based robotic trader. So I'm trying to find the best of both worlds by using my intuition and my scout mindset to find lucrative areas of increasing performance through artistic judgment and craftsman knowledge. And then when it works, add some scientific principles to it and render that into a manufacturing process that improves my rules-based systems that I can teach to others. So uh, that's what I want to say about decision making and improving our decision making over time. That's what organizational decision theory and organizational science explores, is how do I systematically incorporate insights from many different data sources, people and databases and computers and software under time pressure in a world of VUCA. How do I design a system of decision making that I can code and protect myself against my own variations in judgment that are triggered by my human factors? Like I'm cold, tired, wet, and hungry, and pissed off, or greedy, or distracted. All of those things can affect the way that I make artful judgments. So how do I protect my decision making against those kinds of variations? That's what Donald Wheeler talks about in understanding variation, is learning how to identify the different sources of variation in a system and then doing things to reduce the variation at all of those different points so that I can minimize the variation of the overall system. That is that combines psychology and industrial manufacturing, which is why I believe our background in things beyond the world of just pure trading gives us a competitive advantage when it comes to finding robust systematic solutions to the 10 giant challenges of psychology and the 10 challenges of systems and the three major categories of market challenges. All of those things demand comprehensive solutions and professional judgment to find the best answers for people in the long run, which is why I believe that the professional mindset and a habit of mind of continuous improvement is essential for success long term. All right, that 15-minute answer consumed the 5 minutes that we had available, so I'm gonna can it there. I would invite all of you in the sound of my voice to reflect on this, and if you have additional questions, either from week 1 or week 2, just send them to me, and we'll try to roll it forward into the session on next Wednesday on the 24th. So take good care. For those of you that are sticking around for the nightly strategy podcast, that's going to start in about 7 minutes. We'll get, but I have to give this time to process. So take good care, stay safe out there, and see you soon.